Interesting that Kashkari, also notable hawk, is saying that they haven't ruled out the possibility of a rate hike, even though I think the chairman, Fed Powell, was pretty adamant that rate hikes were not something that they could foresee happening.
Yeah.
Let me just start off by asking you what you are anticipating the Fed to do the rest of this year.
Well, in terms of rate hikes, we think that's probably not going to happen. That's off the table.
Yeah.
Neil Kashkari, obviously a very smart man, but he's kind of on the conservative side. And, Powell laid out the fact that, okay, they're somewhat happy with the path of inflation. Inflation stalled for the first quarter of this year, maybe because of loosening of financial conditions last year. We think that reverses, and we think that about 2 to 3 rate cuts are probably in the cards starting second half of this year. And that might be catalyzed by the fact that we're going into a weaker employment market. If you look under the hood of the employment market, the headline numbers have been printing strongly, except for the last print. But the unemployment rate did tick to 3.9% in the last report. I think the Fed's equilibrium level is about 4 to 4.1.
Yeah.
That could start catalyzing a couple of cuts. And if we're sufficiently restricted, they might want to move away from that in order to lessen economic damage down the line.
And slowly start getting to where they need to be.
Yeah.
Let me just ask you a question, wearing your fixed income hats. I thought it was interesting yesterday that these 2-year and 5-year Treasury auctions in the U.S. tailed. That was a catalyst for fixed income to move higher. We had quite a big sell-off yesterday, 7-8 basis points. What is it about where these yields are trading that is not appealing to investors? I would have thought they'd be licking their lips and jumping into buying fixed income here.
We are kind of licking our lips, to be honest. We think that the risk to reward is favorable to get into fixed income. I think the market is quite nervous about the macro. They're quite reactive to every economic data print that comes out, and we got some strong PMIs. Yields spiked up. We get a week later report, yields dropped down pretty drastically.
Yeah.
So I think that the latest piece of economic data that came out is kind of spooking investors again that, the Fed might actually be on hold for a little longer than anticipated. They might wait for better levels. We're not in that camp necessarily. We're not leaning into fixing them fully. We are overweight, but we're slowly adding positions, especially on the longer end of the curve.
Yeah. What's the old adage? Don't fight the Fed, though. If they're telling you they're not going to be in a rush to cut rates, then it may be a tricky trade to hold on to.
Yeah, it is, but you kind of have to preempt that a little bit, right? So by the time they actually get to cutting rates, you might be a bit too late to the game. So you have to position yourself.
Yeah. How much do you worry about the fiscal premium right now in the U.S. Treasury curve?
Look, that is something that we watch. Obviously, the fiscal deficits is going to be a problem time and time again. There's going to be a lot of printing and weakening of the dollar that comes down the line in the longer term. We think that, the Federal Reserve has come out and the Treasury saying that they don't want interest rates to go much higher because the cost of borrowing is becoming prohibitive to them as well. Which force wins in the end, I'm not really sure, but that is a worry that we keep in the back of our minds.
Yeah, I think for many
But I think that the
as well.
overall macro will be more important, so where inflation and employment goes, at least for the short to medium term.
Yeah. Question about credit. I was having a look this morning, just on the terminal. I was, sort of typing away. CDX spreads struck me as really tight. Same for high yield. It just feels like credit is trading extremely tight in this environment. Given where credit is, would you rather just own duration outright and U.S. Treasuries over credit?
So we are owning U.S. Treasuries, but also high-quality credit, which is a Treasury proxy on the longer end of the curve. Credit spreads are very tight, even in EM, in U.S., across high yield, across IG. They're trading at some of the tightest levels we've seen in a while.
Yeah.
That's due to probably there's still a lot of liquidity out there. The global economy hasn't fallen off a cliff. U.S. is still chugging along quite well, so people are taking on that risk. On the overall yield level, it's very attractive, so that actually causes spreads to actually tighten or remain tight for a while. We do think they're tight. We're not adding massively on credit, but, I don't see any credit spread widening event on the horizon yet. If it does happen, it'll be quick, and I think that'll be a chance to add more to credit positions.
Yeah, keeping an eye on local markets. I saw Saudi issued a 5-year sukuk yesterday for the first time since January. How are you thinking about local fixed income markets here?
So EM has been a GCC has been a relative safe haven within the EM space due to not only elevated oil prices, but significant improvement in the fiscal and external positions of government. Handling of COVID really well. The region is kind of booming. There's a lot of growth prospects. We're still positive on the region. Obviously, we don't think that's derailed anytime soon. But again, valuation is quite stretched out. It's quite expensive. We find pockets of value just here and there, nothing too attractive. But we think that, it could still remain a relative safe haven within EM. And we're actually quite still positive on UAE and Saudi.
Okay, interesting place to leave it, especially because so much of our show, we talk about the geopolitical events that are happening in the region, and then here's a fixed income investor essentially telling us that it is a place that you want to be and a relative safe haven space in EM.
So on the geopolitical front, we are watching all the events like everyone else, obviously. We haven't seen any significant geopolitical risk premium being priced from a credit point of view. To our surprise, actually. Should that change, that might change our view and how we look at it. But so far, it's remained pretty well intact because the fundamental story is pretty strong.
Yeah.
And if the thing spills over quite drastically, that might be a bit of a problem.